Welcome, everybody. My name is Stephen Rothstein. I'm the Managing Director of the Series Accelerator for Sustainable Capital Markets. We have an incredibly distinguished group of people on today to talk about how U.S. insurance regulators are taking action on climate risk and financial oversight. And thinking about these 5 distinguished leaders that we have, I'm reminded when John Kennedy was president, he had all the living Nobel Prize winners eating for dinner. And he said, there's never been this much brain power in a room, except for when Thomas Jefferson ate here alone. Well, having these 5 leaders together and all the work that they're doing and is quite remarkable. So appreciate that. Also appreciate the leadership from the NAIC on all the things you're going to hear from today. And obviously, Mike Peterson and everyone else on the logistics. So again, I'm going to jump in just because we have so much to cover. I want to first welcome, we have Superintendent Elizabeth Dwyer, Rhode Island, Andrew Stoffi from Oregon, Kathleen Bahrain from Maryland, Ricardo Lara, I'd say from California, but today he's actually from Egypt, and Grace Arnold from Minnesota. So Commissioner Lara, who's connecting from COP, can you tell us about this? Tell us about COP and tell us about the success of the past year, and how are your goals for California intertwined with those from the other states? And welcome.
Thank you. It's great to be here, Stephen. And I have to correct you just because Commissioner Stolfi is going to do it anyways, but it's Oregon, not Oregon.
Thank you.
Great to be logging on with everybody from Sharm el-Sheikh, Egypt, where we just wrapped up COP27. And as you can imagine, it's been a whirlwind, but a very successful COP, in my opinion, and particularly as we continue to connect insurance with climate change and the great work that we're doing at NAIC. And again, it's such an honor to showcase what we've been doing as our climate and resiliency task force, and really the substantial progress we've made in 2022. And to be able to showcase the work that we're doing as U.S. regulators, I have to say to my fellow colleagues, it was tremendously well received. They're excited to see the potential and what new products come out as we continue to tackle climate change, and we work towards really improving the protection gap in the United States. So as you know, Steve, we have 5 work streams in our task force and have made considerable progress in this past year. And I want to just give you quick 4 examples. We continue to prioritize pre-disaster mitigation, really holding presentations and meetings, including with researchers like the Institute of Business and Home Safety, to better understand how we reduce the risks for homes and communities. Again, insurance is often thought as something we need after the disaster, but why not start working with risk experts to show us how do we actually prepare and how do we strengthen and mitigate against these perils before the disasters happen. And several of our members have been very successful, successful state implemented programs that fund home hardening against storms, including Alabama, North Carolina, South Carolina, and a proposed program in Louisiana. In California and in Colorado, we have programs really focused on home hardening for wildfire, and state insurance regulators are focused on the risk portfolio of their jurisdictions, and these can really advise on how best to achieve climate adaptation through home hardening and community hardening as well. This year, our pre-disaster mitigation workstream helped our members become more informed about how to mitigate severe connective storms and about home hardening for wildfire risks. Building home hardening tools and programs is going to be critical for protecting consumers in all our states. And secondly, we've also built an incredible new collective resource for our states and jurisdictions at NAIC. I'm so proud that we were able to establish a Center of Excellence for Catastrophe Modeling. This center will, one, help facilitate insurance department across, allow us to access and give us that access to catastrophe modeling documentation that we might not all have or in our individual departments. 2, it's going to provide education and training materials on, I would say, the mechanics of models and treatment of risk exposures. And it's also going to conduct applied research analysis, which is critically needed, utilizing model platforms. This center will demonstrate the value of our states and our jurisdictions working together as we tackle these issues. Our third achievement, I would say, is that our solvency workstream, which my colleague Commissioner Bahrain leads and has done a fabulous job, made 3 recommendations that are now moving forward for further consideration. Commissioner Bahrain, I'm sure we'll talk about that further. And fourth, we've modernized the climate risk disclosure survey used to align with TCFD recommendations. As you know, the international standard, this is the international standard for climate risk disclosure. I'm proud to say it was a bipartisan group of 15 states and jurisdictions that are implementing the new climate survey. It's only scheduled to grow in the number of states, getting us close to 80%, if not more, of the entire US market. And each of these successes, we've come together as state regulators and made progress really on the tools and strategies that help our communities be safer and grow more resilient.
Well, that is so much there. I could spend the next hour just asking you questions about all those, because it's so much impressive work. But you referred to Commissioner Bahrain, and you lead the NAIC's work stream on solvency, as was just mentioned. Can you describe how state insurance regulators are currently using the financial solvency tools to assess the risk? Follow up on what Commissioner Lara just said. Commissioner?
Sure. Well, thank you, Steve. And it is really a pleasure to be here today with you and my fellow commissioners. Just to level set for folks, assuring that insurance companies have the funds that they need to pay claims and otherwise meet their financial obligations is one of the most important things that we do as insurance regulators. And the U.S. insurance regulatory system has developed really an extensive set of tools to assess and analyze insurer solvency and liquidity. And those tools have evolved as the risk landscape evolved. And we are certainly well positioned to address the challenges presented by climate-related risk for insurers in underwriting, investments, and insolvency both today and into the future. So it's important to understand that the US-based system is designed as really an early warning system. It operates to assist regulators to identify insurers that are experiencing financial problems so that we can intervene early and assist companies to correct course. So we have a variety of tools that we use to do that. First and foremost, we have an extensive annual and quarterly financial reporting requirement system using very specialized accounting rules that are known as statutory accounting that are very conservative. And this information is analyzed in accordance with the Financial Analysis Handbook, which was developed in 1997. It's updated annually. It's premised on a risk-based approach to financial analysis, and it's designed to assess risks based on really 9 branded risk classifications. And they certainly capture within them the financial risks that are associated with our changing climate. So that's one way in which we are and have been actively engaged in evaluating the financial risks of our changing climate on U.S. insurers. In addition, in assessing an insurer's financial health, state regulators rely on a risk-based capital framework, and that uses a formula to determine the minimum amount of capital an insurance company really needs to hold based on its risk profile. So the analysis of that risk profile is very important, and the components of this formula are adjusted regularly to address various risks that are associated with insurer activity, including underwriting risk and investment risk. And that includes climate-related risks. So, for example, a specific charge for modeled catastrophic hurricane, earthquake, and wildfire exposures requires insurers to hold capital sufficient to cover their worst 1-in-100-year event and requires insurers to disclose far worse events, such as a 1-in-250-year event or a 1-in-500-year event, both before and after reinsurance is considered. Another tool that's utilized are financial examinations. So companies undergo very extensive, detailed financial examinations that are conducted in accordance with the NAIC's Financial Condition Examiner's Handbook. They're not just audits, they're prospective and risk-focused in nature. The current handbook includes several references to climate risk, including a request for the company's review of climate risk in the planning questionnaire and the senior management interview section. In several states, including my home state of Maryland, have implemented a much more extensive questionnaire focused on climate risk. Another tool that you hear about, people may have heard about, is the Own Risk and Solvency Assessment, or the ORSA. This is an internal process that's undertaken by an insurer or a group to assess the adequacy of its own risk management. It requires insurers to analyze all reasonably foreseeable and relevant material risks. The U.S. framework requires insurers that are above a specific premium threshold to implement a risk management framework. They're expected to conduct an annual ORSA, to identify material risks, to document their process and the results of their assessment, and provide a confidential ORSA summary report to the lead regulator. We use this information to assess an insurer's risk management strategies and to review with them the risks that they've identified and how they're addressing those risks. And that certainly includes climate-related risks. And I say, finally, the NAIC has extensive data collection, and of course, the new TCFD-aligned climate risk disclosure are very important tools that regulators use to laser in on climate risk. So what I would share with you is that, taken together, these existing financial tools serve a really important role and give us the framework that we as U.S. regulators need to oversee the financial solvency risk of companies, not just generically, but specifically with respect to an insurer's exposure to and management of climate risk. Having said that, and we'll probably talk about this a little bit later on, there are ways to enhance that and to improve our oversight in iterative fashion.
Like Commissioner Lara, Commissioner Brain, you said so much. Again, we could spend the rest of the hour just talking about that and all the work on solvency. It's so critical, and appreciate all that you're doing and the task force. But in the interest to kind of capture the variety of other things, I'm going to move on, encourage other commissioners to jump in throughout this. Commissioner Arnold, when it comes to mitigating the risk, as you know so well, state regulators are very interested in understanding how to incentivize mitigation to reduce potential loss. What options do you think exist to help incentivize mitigation of property damage? Commissioner?
That's a great question. So, I think one of the things that's unique about each of our states is we each have our own kind of risks to think about that are unique to our geography and our weather and our climate. So while Commissioner Lara and Commissioner Stolfi worry more about wildfires, we have blizzards, the severe thunderstorms, and flooding that are more common, although we have had wildfires in the past couple of years. In Minnesota, we've had 3 $1 billion storms already this year. And as I mentioned, we're exposed to severe weather in all 4 seasons because we get all 4 seasons. One of the things that I'm really glad about is that the NAIC has focused on pre-disaster mitigation strategies that can be kind of win-win-wins and cover a range of disasters that consumers in a state might face. Recovering from a severe storm or a wildfire can be really financially devastating. And state regulators are really interested in understanding how we can think about ways to incentivize behavioral changes so that it's less expensive, so that we do a little bit upfront so that the back end of claims and recovery is less financially devastating and also easier for people, because that can be such a burden, not just financially. So, what we're driving towards is that, a home or a business owner can make their property more secure from natural disasters as a cost-saving measure. Sometimes there are things like health and safety improvements that come along with that. So there really are a lot of wins that we can get out of some of these investments. Insurers who write policies for structures that are strengthened against climate-driven perils should pay out less in claims. And so then consumers should be able to it can also be able to realize some benefit there. It's also a reduction in risk across the board, so that's a win for insurers. And then state regulators can get the benefits of kind of all of this because we have more consumers that are more resilient, insurers that have sort of less overall risk, and citizens that can be able to recover more quickly and be more resilient in the face of natural disasters, whatever those might be.
That's great. That's so helpful. And your reflection, about how different parts of the country are so different, but that the idea of reducing risk can also reduce claims, which obviously is cost, not just health and benefit, but financial. So it's great the work you're doing, and obviously there's so much more that needs to be done in there. I'm going to shift a little bit to a few questions about what are some of the tools that regulators are using to reduce physical risks of wildfires, storms, floods, and things like that. Superintendent Dwyer from our neighboring state in Rhode Island. One of the successes that Commissioner Lara mentioned is the creation of the Center of Excellence for Catastrophic Modeling. How do you see this being beneficial to states, and can you talk more about your work on pre-disaster mitigation?
Yeah, so thank you. And it's a very great panel to be with today. But yeah, so I am really looking forward to what we as commissioners have set up through the CIPR, the Center for Excellence. We, of course, are an Atlantic Ocean state and subject to hurricane risk. And we've been dealing with models for as long as I've been here without a lot of information. And we share among ourselves. Florida is certainly a huge place of information for us to go, but there's always questions. So how does this model affect your state? How does, how should we interpret this? What mitigation measures are best for consumers? And I'm looking forward to the Center for Excellence bringing all of that expertise together to allow us as individual states to kind of mine that. We know our individual states and we know what the effects are here, but this is going to be a repository of information. So I'm really looking forward to it. Sometimes it's, we are exposed to hurricane risk here, but we really have been, I shouldn't say lucky, we really haven't experienced a serious hurricane in decades. But that doesn't mean that we shouldn't have our eye on the ball and understand what risk mitigation can bring to the table. But one thing, so my state, which is called the Ocean State, we have more coastline than probably regular land because we have Narragansett Bay cutting through the state. The largest flood risk we had, the largest flood disaster we had in this state was a rain event. So we have been focused on coastal, and suddenly we get this rain event that literally shut down Route 95, which runs right, Florida to Maine. So that kind of information, what are our risks, is so important for all of us. And I'm really looking forward to what CIPR is going to be able to bring to the table.
Great. Well, it looks like such a resource. And as you said, disasters happen in all different shapes and sizes. That it could be from floods, but the rain events and streams and other things. So having that data that everyone can have will be a real tool. Let me go back to Commissioner Arnold and then afterwards over to Commissioner Stolfi. But Commissioner Arnold, pre-disaster mitigation requires, as you know so well, excellent coordination among government agencies and local governments and others. As an insurance regulator, what role have you played in your state strategies on reducing risk to individual communities?
Yeah, it's a great question. And, I think each state has a little bit different structure. And I think we're all very uniquely situated to find the right ways to do what I'm going to talk about, what we do in Minnesota in our own states. So one of the advantages of my role as the Minnesota commissioner is that we regulate over 40 different industries in our state and have a really wide-ranging view of our state's economic exposure to climate-driven perils. One of the things that's unique about our department is that we have the Minnesota State Energy Office within our purview. And so we have a unique insight into the critical infrastructure and community resilience planning for disasters as part of that organization's sort of statutory requirements. We're working every day to integrate our understanding of the insurance risks that our regulated entities face with the physical and transitions risks that our regulated utilities that provide energy within the state face. In Minnesota, we also rolled out just in September a climate action framework that provides a really positive roadmap for where we want to go as a state within 6 goal areas. Took us 3 years to build, and has there are 16 executive branch agencies that participated in the work that kind of structured that framework. This kind of multi-agency work where we can lead together as a team to think about resilience and pre-disaster sort of abilities, from not just what a structure would look like or an insured structure, but like, what is the community? How is the community resilient? How is the natural landscape around that structure resilient? We can kind of think together across all the agencies in our states to figure out how we can have conversations with local entities, provide funding or other resources to make sure that not just the structure is resilient, which I talked about before, why there are benefits to us as insurance regulators, but the entire community. And I think that us as at the state level as insurance regulators, we have just a really unique position and a really great opportunity to be able to drive some of those conversations and partner together with our colleagues to realize the benefits, not just to an individual insured, but to communities as a whole.
That's impressive. That multi-agency planning, I'm sure, is already paying dividends, and that coordination both at the state level with national colleagues and with local colleagues. That's helpful. Let's shift to the beautiful Pacific Northwest. Commissioner Stolfi is one of the leaders in this. Many of the Western states, again, this, I mean, I don't mean to tell you anything about this, have felt the impact of severe wildfires. As you and I have talked about, one of my sons lives just over the border in Vancouver and has felt it literally in his home. How are the wildfires impacting insurance markets, and what are the successful strategies for reducing those impacts, Commissioner?
Thanks, Stephen, and good morning to everyone from beautiful, a little chilly this morning, Oregon. Glad to be with you. Thanks. Really appreciate being here with my colleagues, and especially grateful to Commissioner Lara and his staff for helping to organize this. So first, I want to give a little bit of context to it, so those who may not be familiar, especially with Oregon's situation. So over the last 5 decades, we've really seen a dramatic change, and that change occurred around 2020. So from the 80s through the 2010s, during each of those decades, we saw in Oregon catastrophic losses that all fell well below $500 million per decade. So $500 million per decade from the 80s through the 2010s. So that all changed in the 2020s, with wildfire losses alone already estimated to exceed around $3 billion just 3 years into this decade. Our neighbors to the south, California, have seen a similar trend at a much different scale, and about a decade earlier, they saw about $5 billion each decade in losses until the 2010s, when that shot up over $30 billion. So climate change has really driven really increased losses here along the West Coast. It's undeniably terrible. The silver lining, perhaps, for us in Oregon at least, is that California is about a decade ahead of us. So they've got about a decade more experience dealing with these disasters. And strength of our state-based system is that we're able to share and learn from each other. And we really had an opportunity to lean on California's experience over the last few years. And that really hit in 2020 for us. Our largest event probably ever was around Labor Day weekend. We had 5 simultaneous mega fires over 100,000 acres. We burned 1 million acres in just a few days. For context, that's about 1.25 Rhode Islands burned in just a few days. So within a few days of that, Commissioner Lara and his staff were on the phone with us, again, sharing their expertise. So it's a little bit of background. The impact, as I said, is really undeniable, and how it's increased over the last few years. Insurance, of course, is based on experience, the experience and losses that insurers have. And just in that weekend alone in 2020, we've had more than $1 billion in losses just from that one event. So what happens, of course, insurers are evaluating their losses, their experience, their risk. So within, months after that, we started to see indications of a little bit of changed behavior, and we've heard more and more over the last year about individuals, especially in the WUI, the wildland urban interface, getting cancellations or non-renewal notices. And that's, again, it's not so surprising. Again, insurance is based on experience and losses, and especially when we have regional or state carriers who are trying to reduce their concentration risks. The good news for us is we've got a robust market, 150 plus carriers, our state fair plan, we've got a surplus lines market, of course. So homeowners and businesses can always find coverage. The problem for us is that the cost of that, we're seeing that sometimes double for a homeowner who's getting a non-renewal or a notice of their rate. So there's definitely an impact. So what strategies are we doing to reduce those impacts? And the answer is many things, and that's good because you have to do many things. Some of these are directly insurance related and directly within our control. Many are not maybe directly in our control, but we're able to influence and participate in that and work with others, as Commissioner Arnold was indicating, which is a really important thing. That coordinated approach is really necessary to address all these risks. So our legislature just last year passed a law that really helped solidify this and bring a lot of things together. Let's talk about a couple parts of that. It created a council of stakeholders that get together. We're on that, so it's community members and state agencies who are involved. And we get together and we coordinate. They created a wildfire director role right in our governor's office to help bring all these different agencies together. It also required us to work even closer with the feds. In Oregon, we've got the 5th most federally owned land in the country, and more than 50% of our state is owned by different federal agencies. So there's a real necessity to coordinate between the state and federal entities on responses. And then we kind of grouped our mitigation strategies, our responses into 3 main areas. One is readiness and response related activities. This is like our Public Utilities Commission. You saw this in California as well. Having to put together mitigation plans to shut down power lines in wind events, and that we used that this year. Increased capacity among our wildfire response agencies as well, and increased funding for them. The next is funding for more resilient landscapes. This is really important, encouraging and promoting prescribed burns and better forest management and forest thinning activities in partnership with local and federal entities and our tribes as well. And then last, the fire adapted communities. And this had a couple things directly relevant to us. I created a state wildfire risk map, which is not only a great educational tool, it kind of identified where the WUI is and classified properties at the lot level into high and extreme and then low risk levels. And that map then had legal consequences, because if you were in the WUI and had higher extreme risk, you were required starting next year to put defensible space, to create defensible space around your property. That's going to be enforced starting next year. You're also required, if you're in that category, to harden your home and to put into place special building requirements. And I'm not only the insurance commissioner, I've got the building codes division in my agency, so we're directly involved in those activities as well. And there are some land use things. So to sum it up, the key in all of this is really to reduce risk, and that will certainly take time. We actually did see a favorable fire season this year. I think in part to increased management and response activities funded by the new law. And I'll close, just dig into just insurance specific strategies really quick and mention 2 things where we're helping consumers reduce the impact from wildfires. And the first one's easy and everyone here can do it. And that's educating consumers on their options. So after someone gets a notice of non-renewal, a cancellation, or having a hard time finding insurance for a new construction, they have lots of options. I mentioned we've got more than 150 companies, a fair plan. And when we have people come to us with these notices, we really encourage them to shop around and also to be aware that their insurance agent, who they may have been dealing with for 20 years, may have limited options. They might need to go talk to another agent or seek help elsewhere. And the second, last thing I'll emphasize is that we really need our insurers to take account of the strategies that we're implementing. So these defensible space, home hardening requirements, community risk reduction activities, insurers have to take account of those in their underwriting and rating practices. You know, we are as a state investing a lot of money into this. Homeowners are going to be investing a lot of money into this, and there should be a benefit from that from their insurers. We're actually running a bill next year to help require this. And I'm by saying this just will take time, and we're unfortunately going to have to be patient. You know, defensible space requirements will come into place next year. Home hardening is only for new construction. There's a real opportunity to have grants to help existing homes do those activities, but I think we're going down the right path and have a lot of good stuff here. And again, grateful for our partnerships, California and others. Thanks.
Wow. Like your colleagues, we could definitely spend the rest of the time just on this. I mean, from the initial part of it, the sobering numbers you outlined about the problem in terms of billions, obviously, and that impacts individuals, their homes, their businesses, their schools, and to the comprehensive set of initiatives that your state is doing. Obviously, more, as you say, more needs to be done by everyone, but from the home hardening to the grants to the collaboration, the building codes, there's so much there. So I'm sure there's a lot of states that can learn from those. Let me go just south. Commissioner Lara, you're obviously facing wildfire risk, and for many years it's been discussed. What tools have you used to reduce the physical and financial impacts of climate intensified wildfires in California?
Thank you, Stephen. And as you can see, this is why our real estate-based system and being able to have these conversations with our colleagues across the country about the work they're doing, and being able to have that center of excellence to be able to collect all this data is critical, and why I'm so proud to be part of NAIC and contributing to this fantastic work. And of course, as you know, we've experienced devastating wildfires in California as well, particularly I would say in the last 5 years. And in order to keep insurance available and affordable, again, everybody's saying the same thing. We need to mitigate this risk. And there are home hardening actions, as you heard from Commissioner Stolfi, that you can take for your home or your business. And there's also actions that we created in California that really look at what the community actually must take together. One of the things that when I was visiting these fire devastated areas were complaints from consumers saying, you know, I've invested thousands of dollars in my individual property, but maybe my house abuts a federal forest, or a neighbor who hasn't done any of the home hardening things, or it's abutting a city or county property that is not properly mitigated. And so that was also affecting people's ability to access insurance. And why we started thinking, well, how do we address this community-wide risk so that there's an action plan that the community as a whole could do? And by the way, and as we've seen it implemented in California, it is a fantastic way to actually find out who your neighbors are, understand if maybe there's a neighbor who may be a senior citizen living alone and looking out for each other. So it started to create in California really good networks of different communities, and kind of putting that human aspect to resiliency, right? As maybe there's a retiree who can't do the mitigation, and I've seen neighbors come together and help mitigate that home. And that all started through our community mitigation kind of standards and work. And in California, we spent a year working with an interagency partnership, something that I thought should have been happening a while back, as Commissioner Stolfi also has done, is why aren't these agencies talking together? Everybody who touches wildfires or emergency responses. And so we created this interagency partnership of wildfire and emergency management agencies to really develop an easy to understand list of home and community hardened actions that homeowners and communities could implement. Actions that were backed by science, that were clear and consistent, and most importantly, achievable. And we brought in the insurance companies and the insurance company trade organizations so that they also understood and were working with us about these are the things that they are asking consumers to do in California to mitigate that risk. And then in 2022, I drafted regulations to actually require insurance companies to provide incentives and discounts for hardening your home and your communities. And these regulations were completed in mid-October and are now being implemented. So I'm proud to say that in 2018, there were only 7% of homeowners in our state that had access to home hardening discounts. Once the regulations are fully implemented, every home in California, regardless of where you live, will have access to incentives to reduce wildfire risk. This incentive is going to make our community safer, give consumers discounts for bringing down their risk, which is of course critical to reducing future losses, protecting our air quality, and empowering resilient communities. Here at COP, I was on a panel the other day, and one of the climate scientists said that all the great work that we've done to reduce emissions in California were essentially wiped out because of our wildfires. And that's how voracious these wildfires are, and really take us back in terms of the emission reductions that we've worked so hard and are so proud of in California. And research groups like the Institute for Business and Home Safety and university researchers have played a really important role with us as well in terms of how do we create not only these incentives, but how do we use insurance as an incentive to do the right thing. And the way we do that is by requiring insurance companies to offer these discounts so that people are incentivized to do this. We're also created regulations to give much more transparency to what these fire risk scores are for neighbors. So many consumers were getting letters saying that they were being dropped because their wildfire risk score had doubled, but yet the insurance company wouldn't tell you how they achieved that score, what algorithm was used to decipher that or to determine that. And there was no ability for people to mitigate or to respond to the score. And so now with this regulation, this gives more transparency for consumers to fully understand why they got this risk score, how they obtained it, give them time to actually mitigate and do some of this home hardening to bring their score down and hopefully keep their insurance policy on their home.
That sounds, again, as you say, hearing from so many states, there's so many great ideas here, and that regulation between the incentive for everybody in the state to the more transparency. There's no problem that can be managed if it can't first be measured, and having that is a key step. So you deserve a lot of credit for that. Again, we could spend more time on that, but in the interest of just time, I want to move on to another broad area about what are some of the financial supervisory tools that U.S. regulators are using. And back to Commissioner Bahrain, you have led, as was discussed earlier, the Solvency workstream to consider potential enhancements of existing tools and discussion of how to approach these risks. What recommendations did the work stream make? And looking forward to the future, what do you see as next steps in 2023? And how do you see these tools being useful over the longer term? Commissioner?
Oh, sure. Well, thank you. As you know, the Solvency work stream really has been focused on, of course, the climate-related financial risk. And we're one of our core goals as insurance regulators, which is the prudential oversight of U.S. insurance companies. And our goal, obviously, is always to make sure that risk is identified, it's analyzed, and it's appropriately addressed. We use, as I mentioned, I ticked through a number of them earlier, the comprehensive set of tools that allow us to monitor and assess financial risk. And those already include financial risks that are associated with climate change. But it is important for us to make sure as regulators that our licensees are focused on climate-related financial risk. And so we have made efforts over the last year or so to begin to target those tools and enhance the climate-specific oversight. So In that regard, we spent a year looking at, what enhancements make sense at this point, recognizing this is going to be a very long-term iterative process. And at the end of last year, the beginning of this year, we made several referrals to e-committee working groups that oversee these solvency tools. So the first referral is a suggestion to the Financial Analysis Solvency Tools Working Group to consider modifications to incorporate particular concepts as they pertain to climate risk and offer high-level principles to consider and develop as appropriate for inclusion in the Financial Analysis Handbook. So specifically, the referral suggests that the working group consider modifications to incorporate procedures for utilizing the property casualty RBC CAT reporting data and any investment stress scenario results available from the NAIC Capital Markets Bureau and the Climate Risk Disclosure Survey results in conducting ongoing financial analysis. So taking a look more closely at how these existing tools and information can be utilized as part of each state's ongoing financial analysis of its domestic. The second proposal looks at the Financial Examiner's Handbook's technical group consideration and has a list of enhancements that are proposed to the Financial Condition Examination Handbook. And specifically, we recommended additional focus first on the insurer's exposure to and management of climate change risks as part of the planning phase for every financial condition examination. And then in addition to that, we've made recommendations, detailed recommendations with regard to the enhancement of the investment underwriting and reinsurance assuming repositories to more directly address climate related risk changes and stresses. So an example would be considering enhancements to the investment repository risks to encourage consideration of both energy transition and physical risks on an insurer's investment portfolio and strategy. So again, honing in and lasering in on specific climate related financial risks. The third recommendation offered a list of possible enhancements to the ORSA. So the goal here would be in requiring an insurer to include a description of how climate change risk is addressed through their risk management framework and providing more specificity as to how materiality should be evaluated and discussed within the ORSA. An important aspect of this referral is for the ORSA to consider the material, medium, and long-term impact of climate change on the company's near-term risk appetite, their asset management, underwriting, and business strategy, as well as their efforts to limit the impact on near-term solvency. So, the ORSA tends to be, a near-term, document looking at risk over, maybe a 3-year horizon. But climate-related financial risk is a much longer horizon. It's a much longer analysis. And so the goal here is to see how the insurers thinking about their long-term risk, how that is impacting their near-term analysis and their near-term efforts. So those are the 3 referrals that we've made. The working groups within the E-Committee have them and have taken them up and are working on them, and will continue to follow them very closely in our solvency work group and add whatever assistance we can to their efforts. If we turn a little bit to the future, I would say this year for 2022, we have been focused on climate scenario analysis and evaluating what role that could and should play with respect to U.S. oversight of an insurer's climate-related financial risk. The work stream, started as has been our want to develop a foundational level of education regarding the development and conduct of climate scenario analysis exercises. We heard great presentations, really candid presentations from a number of international supervisors on how their jurisdictions are looking at and requiring climate scenario analysis, how those exercises were designed, how they've been implemented, and what's the value proposition been? How valuable were the results to them as regulators in understanding those scenarios and what they would mean? And frankly, how valuable were they to the companies. So we had a great session with respect to that. And those perspectives will now be supplemented by an industry perspective during our next panel, which is on Tuesday, November 29th. And a really important component of that discussion is really going to be around data and the extent to which there is a sufficiently reliable data to inform exercises that focus on, say, for example, investment portfolio or risk. The workstream will then do what it's done in the past, and this will bring us into early 2023, which is to consider how do we right-size scenario analysis in the US. So we need to think about what kind of scenario analysis is useful, what designs make the most sense given existing capabilities and data limitations. So this will be an iterative process. It'll be an open and transparent process, but I think what you will see in the early spring are some thoughts and recommendations about where US regulators may begin to use climate scenario analysis or direct companies in that regard. But we will probably start with a survey as we did with respect to the other recommendations. And you can see that I would expect in the early part of this year. I will say the one thing that I guess I want to mention that's really important is how all of these topics work together, right? So each of the things that we're talking about here, we're talking about data collection, we're talking about risk analysis, we're talking about how the physical risk, how investment risk, transition risk, all of these things factor together to look at and lead into the financial risk. But it is holistic. And what's critically important, that through the task force, we are looking at things holistically. All of the things that, Ricardo and Andrew are talking about that they're doing in their jurisdictions that Grace has addressed and Beth has addressed, all of these things impact risk, right? So every single time, and they impact, the company's ability to manage the financial aspects of climate risk. So what is exciting is the way in which, the NAIC has been able to come together and bring all these thoughts together to create what is really, a holistic approach to how we address climate-related risk financing as a society.
You're so right, and I mean the work of the work stream, the task force is so important. As you say, from the financial handbook to ORSA to the scenario analysis to so many other things that you said that make such a big impact. I am very excited to see about the next steps, particularly on scenario analysis. I think that'll affect everybody. So appreciate your leadership and all of your colleagues working together on those areas. So thank you very much, and on each of those areas. I'm going to go back to Commissioner Stolfi. You and Superintendent Dwyer have been remarkable co-leaders of to update and revise the state climate risk survey currently being used in 15 states. And as Commissioner Lara said, represent 80% of the market. The revised survey is now aligned with the international reporting standards of the Financial Stability Board's TCFD, the Task Force for Climate-Related Disclosure. Can you describe the importance of aligning with the international standards in the thinking of the task force, and invite anybody else to jump in, but Commissioner Stolfi?
Thanks. Definitely. And just want to go really quickly back to the regulation that Commissioner Lara mentioned, because I can't emphasize enough how important that activity is. And it's not just because we're copying and expanding upon it next year in a piece of legislation, but a lot of the things that we've all been discussing about risk reduction, and this isn't just wildfire related, it could be around floods and wind and hail, et cetera. So it's for everyone. A lot of those things are outside the direct control of insurance supervisors, but what is within our direct control is making sure that the companies we regulate are taking account of those mitigation strategies. So just really want to emphasize the importance of that and encourage every other commissioner to look into looking at that. But so as your question around aligning with the TCFD, first, quick disclosure of a potential bias here. I did work at the IAIS for a couple of years before coming to Oregon. So setting international standards when I was there, I've long seen the financial sector and global economies as interconnected. which then I think demands a need for international consistency in many areas. Climate-related issues are also deserving of international approaches, right? So hurricanes, wildfires, other climate change fueled natural disasters don't respect boundaries, whether state or international. So we do need a global interconnected approach to that. As for the TCFD recommendation specifically, for me, it was honestly kind of a no-brainer for us to move to a TCFD aligned approach for a couple of reasons I'll really quickly talk about. First, the TCFD itself is already and was already a broadly globally accepted standard metric for companies to disclose climate-related risks. So it was already there. There are 9 other jurisdictions, from the UK to Switzerland and Japan, who are already requiring companies to use the TCFD. IFRS now has proposed sustainability standards that include TCF recommendations, and if those are adopted, that could apply to about 160 other countries, including 15 out of the 20 G20 countries, 3,000 or so organizations already using it. So there's a lot of folks around the world who are already looking at it. So for aligning the NAIC reporting with TCFD, immediately gave us a few benefits. One, for insurers, it gave insurers an established framework to utilize. So for insurers new to this type of reporting, there's a lot of resources out there that they can use, a lot of other companies reporting and approaches that they can look at and copy. We are also helping the NAIC. We've had multiple calls. We've organized assistance for companies, and we will keep doing that for all those new companies doing it. And then for insurers, especially those operating internationally, using the TCFD approach helps streamline their reporting by having one globally accepted framework rather than a patchwork of reporting requirements for them. For regulators, it gives us the same common comparable framework that we can build off of and incorporate into our processes. And for the public, again, it provides that common approach, enables intra and inter and cross-jurisdictional analysis, which is important for the public sector. So again, just moving to this TCFD aligned approach, certainly a change for some of our companies, but honestly, not sure if anything else would have made sense. Thanks.
That makes sense. And obviously your background context is very helpful, and the overview of TCFD, how it's gaining momentum in this country. The SEC is included in their recommendations and around the world. In fact, just recently, the federal government proposed new procurement requirements. If you're a large procurer, supplier to the federal government, that over X million dollars, you'll have to do TCFD reporting, scope 1, scope 2, and scope 3 for some of them. So that's a great coordination. Superintendent Dwyer, again, is a co-leader of this work. And again, I want to thank both of you and all of you for the work streams that you've been doing. Beyond coordination among the states, how have you and NAIC engaged more broadly with the international community, including the International Association of Insurance Supervisors, Sustainable Insurance Forum, and does the new TCFD aligned survey better position U.S. and regulators to participate in some of those international discussions? Superintendent?
Yeah, thank you so much. Just this discussion here today shows how much we can all leverage off each other. The great ideas from individual states can be utilized maybe in a slightly different way in a new state. And we really think that's true internationally as well. This is a global issue. This is not a regional issue. And as Andrew stated, going to a TCFD disclosure, we're hoping that we can align better internationally as well. So what have we been doing in states? We've been participating in the IAIS Climate Risk Steering Group. I was just nominated as the new vice chair. My predecessor in that was the state of New York. So, the US is heavily involved. I believe Andrew is a member. There's a number of other states that are either members of the IAIS group or following what they're doing internationally. We also have, I believe it's 7 members, and I have to say I'm not one of them yet. So I know I'm going to try to become one. And I believe there's some other states getting involved in the Sustainability and Insurance Forum. So just like sharing among the states, we believe that sharing internationally will just bring better solutions to each of our individual locales.
That's great. Yeah, no, that work on the international work is so important, Sustainable Insurance Forum. So appreciate the work you're doing, obviously in your state as a leader nationally and representing those international. Let me shift to Commissioner Arnold and then also welcome both Superintendent Dwyer and Commissioner Stolfi add on if you want. And I ask you to keep these relatively brief because we're running out of time, but you oversee both banking and insurance. I'll start with Minnesota. When it comes to climate risk, how do you see some of the similarities and differences with those two financial industries? Commissioner Arnold first.
Sure, and I do want to note that Superintendent Dwyer and Commissioner Stolfi both are in the same situation, and I think it's super helpful. So, some of it is people. So as an example, our chief examiner on the insurance side started her career with the department as a bank examiner. So she has a real appreciation for both kinds of institutions and what what's similar and what's different about them, and can think about climate disclosure across kind of both of those lenses, which I think is a real asset. We've talked a lot about the TCFD standards, so I don't think we need to go too much into there, but there are regulatory insights that are unique within banking and insurance and are unique to the sizes of the organizations too. So our small community banks that are insuring or that are loaning to mostly farmers in Western Minnesota are going to be really different than some of our larger insurance companies. So, the risk is sort of similar because if you're insuring in that community, then the risk to the property or the folks in that area is similar. But the way that you approach that in terms of disclosure and kind of thinking about how the institution might be impacted is completely different. So, at a high level, we're all thinking about the same kinds of risks across our communities. The way that we kind of think about those for the institutions that are bearing the risks might be a little bit different, but having kind of cross-pollination of knowledge within agencies, I think is super helpful because we can all look at those same high-level risks and then adapt them down, using international and kind of accepted standards as like an umbrella, but adapt them down into the unique kind of markets within our states, but also the unique institutions that exist within our states.
That's great. Superintendent Dwyer, do you want to add anything?
Yeah, so I completely agree with everything Commissioner Arnold said, but I also hope that the banking regulators can assist us in getting some of this information across to consumers. It is very difficult for a consumer to say, I'm going to do something today that's costing me money that might help me in the future prevent a risk. And so I don't believe there's a state in the nation that mandates homeowners insurance, and yet we all have it. Why do we have it? Our lenders require it. So getting with the banks and the lenders and the credit unions to understand that it's not just the consumer's risk. People have large mortgages on their property. If there is a catastrophic loss, the chances of the consumer being able to pay that mortgage while still providing housing for themselves isn't high. It is a risk for the bank. It's a balance sheet risk. And I think we as insurance regulators can help inform banking regulators as to that risk, and they can get more to the consumer. So I'm really hoping by working together, in addition to the 3 states here and a couple other states, the state of New York is also the banking and insurance regulator and has a climate stream that I'm hoping will get more out to our consumers and help us with that level of education.
That's such a good point. Commissioner Stolfi, do you want to add anything?
Yeah, just really quickly, one thing, I agree as well with the other 2 commissioners. I'd say in our discussions with our community banks and credit unions, they're all thinking about this in different ways and to different degrees. But through the work that we've done at the NAIC, I see the insurance sector in the US as being a few steps ahead of our colleagues on the banking sector. So it's kudos to the NAIC for the work that we're doing.
That's great. No, those comparisons between and what the one industry can learn from the other, insurance and banking, is so interrelated. So unfortunately, we're running close to the end of the time. So let me ask a final question. I'm going to give everyone literally a minute to give their perspective. Looking forward, what do you see as the big picture questions you've seen your jurisdiction when it comes to the insurance market, or is there anything else you want to briefly add? Commissioner Lara, I'll start with you for a closing statement.
Perfect. Quickly, just looking forward, I think that finding ways for insurance companies to reward risk mitigation is going to be continue to be an important opportunity. And when facing climate risk, many communities would benefit from home and community hardening. So providing clear incentives that make our communities safer is going to continue to be critical and a priority for us in California.
Very helpful. Those incentives make sense. Commissioner Bahrain, for you.
I would say that Maryland has been a real thought leader with respect to climate generally. But what's been exciting for me is really being able to partner with all of the traditional stakeholders in showing the critical role that insurance plays, not just in the aftermath, but in the in risk mitigation, and being able to bring carriers to that table to really partner with communities to look at resiliency and mitigation. That's been really exciting. We've become real players in Maryland's Climate Commission this year, and really looking forward to continuing that partnership next year.
Great. Now that critical role, as you say, in Maryland and the thought leadership around the country. Commissioner Arnold?
I think, our economies many of us are looking at kind of moving toward carbon neutral economies, and that's going to come with a lot of change within the economy, which is really positive, I think, from a, sort of global perspective and from our community perspective. That will mean that our insurance markets will have to adapt. And I think that I'll echo what Commissioner Lara and Commissioner Bahrain said, in particular, the community hardening. We're also going to see new technologies that need to be insured. We're going to see new kinds of businesses. And I think those are all net benefit to our economies and to, our kind of global goals of reducing carbon and having carbon neutral economies. But we're going to have to make sure that the financial structures that support our current economy can and do, kind of migrate into the future economy.
That's those new economy, the product side, the investment side, all of those are so important. Superintendent Dwyer?
Yeah, so on a micro level, we've been dealing with coastal risk, of course, for many, many years, and working with our insurers that are writing here to understand their needs. So, we understand that there's a need for diversification of risk within the insurer's balance sheet. We try to work with them and get as many companies in here as possible so that our citizens still have opportunities for insurance while still being able to, mitigate their own risk. So getting that across to consumers, how important that is, will keep vibrant insurance markets and therefore keep more opportunities for the individual homeowner. How we do that, everyone today has brought up very good ideas. And I think all of those ideas will be the way to accomplish that. But that's something we're very focused on here, making sure that we work with our insurers and get the right result for the consumers of our state.
Great. Right. As you say, many good ideas are brought up today. To bring us home, Commissioner Stolfi?
Thanks. I'll mention three very quick things. The first, as Commissioner Lara mentioned, is getting our companies to recognize and incentivize risk mitigation activities that homeowners, property owners, governments are doing. Super important. Second, I really want to see the NAIC climate survey participation grow. We're at 15 states, I believe, a few more coming on next year. It'd be great to get the entire country on board with that. And related to that, last, really developing more tools for supervisors to use to fully ingrain that review of climate risks into our regular quarterly, annual, every few year examination and analysis processes. Thanks.
Great, great. Well, all of these ideas, again, we have skimmed the surface of so many amazing ideas. I can tell you that I am inspired by all of you. Your work individually and collectively is making such a big difference. So thank you for your being with us from your home states and from COP in Egypt. We appreciate it. We appreciate the logistical organizational support from California and for this, and NAIC continues to be a leader. I hope everyone has a great day, and we all need to do more to work on this together. Thanks, everybody.
You.
Thanks.